Good evening, and welcome to the second installment of our UW Now Livestream series. Our purpose here is to bring expert analysis on vital current issues from a Badger perspective. The COVID-19 pandemic has touched nearly every aspect of our lives. It's not only a global public health crisis, it has spawned a global economic crisis in its wake. The social distancing adopted to slow the spread of the disease has put economies on ice. The magnitude and pace of the decline in production and employment has been unprecedented. We're all left to wonder what happens next. The potential paths the economy may take resembles an alphabet soup. Will the path of output and employment trace the classic sharp V with a steep drop and a rapid recovery? Will it be a gradual U shape where things go down gradually, stay at the bottom for a while, and then emerge? Or will it be the dreaded W? I know we love the W, but we don't like a double dip recession, and that could happen. Ultimately, the answer will depend on the virus itself, the public health response, the potential for innovations in testing, treatment, and vaccination, plus the actions taken by fiscal and monetary authorities to resuscitate the economy from this virus-induced recession. We've assembled a panel of 3 Wisconsin alumni to share their perspectives on the economic and market outlook. Their positions as investors require them to make objective judgments on behalf of their clients. We are not here for the sake of stoking controversy and selling advertising, although who knows, maybe it'll come to that. I'd like to ask our 3 guests to join me here on stage for a moment, but please keep a safe social distance. We have with us tonight Phill Gross, coming from Boston, Massachusetts. Ricky Sandler is in the Hamptons on Long Island, and Julie Van Cleave is in suburban Milwaukee. Thanks for joining us. Our format tonight will allow each speaker to present for 6 to 8 minutes, and then we'll be taking audience questions using the YouTube live chat feature. So please feel free to chime in with your questions, and we'll get to those once all of our speakers have made their presentations. First, we'll hear from Phill Gross, the co-founder of Boston-based Adage Capital. Phill has spent his career as a healthcare analyst, and he is going to walk us through an in-depth analysis of the backdrop of the COVID virus and how it might evolve over the course of summer and next fall. So welcome, Phill.
Hi, everybody, and thanks, Mike, for having me tonight. I hope you're all in good health and staying safe. As Mike said, my job during this web stream is to set the stage for Ricky and Julie to talk about the investment implications of the COVID-19 pandemic. I'll do this by discussing some of the inputs we're monitoring to analyze the potential scenarios that may happen in the short term and the long term related to the crisis and the process we will go through to reopen the economy. As a healthcare equity analyst for my entire career, I'm in a unique position to be able to talk to many of the thought leaders who are experts in treating and analyzing pandemic disease. Along with my colleague, Alan Zapolsky, who is also a UW grad, we've literally been on dozens of calls with these experts. And my heart goes out to all who have been impacted by this disease and to the healthcare workers in the front line of this crisis. So let's get started. So the current status of this epidemic. The way to look at it is it's a regional rolling epidemic. Italy and Spain look like they're past their peak. The US will be a rolling peak through various regions and states, and we're going to analyze this on a state-by-state basis tonight to give you a glimpse of that. Very few US peaks have actually happened despite social distancing for 3 to 4 weeks. And that's been very, very frustrating to policymakers and has led to this creeping and uneven policy methodology that's been happening. We started with social distancing. We went next to stay-at-home orders. Last week, we started talking about masks for everybody and even locking down. Don't even go to the grocery stores. Don't even leave your house. So if you look at the deaths in Italy and the cases in Spain, you can see there's a clear peak that's happening in both cases. And that gives us optimism as to what's happening in Europe. In the US, if you look at New York, New York may be peaking. And I think that's actually what's led to the stock market upswing these last couple of days. So the market's definitely focusing on a state-by-state peak and the US peak in cases and deaths. And I think this is something that's a very short-term dynamic in the market and something that we need to monitor. It may not be the right way to look at things in the long term. So when we think about tracking the pandemic spread in the US, it's hard to do it by case counts because case counts are related to testing. You're not going to be positive unless you're tested. So the case growth that we're seeing is as much a function of the testing growth as it is true infectious disease spread in the US economy. So the death rates and hospitalizations turn out are the true measure of policy impacts. The problem is that they are actually lagging indicators. So we're going to talk about something called hotspots. And they're defined in our mind as growing tests, meaning tests in that locality are getting more and more testing, and they're showing increased positive test percentage per day. Luckily, most of the hotspots are in the north. And this regionality is one really important thing to focus on, because what we think, and most thought leaders believe, this is probably going to be a seasonal virus, like the regular flu. And that will give us a reprieve through the summer. But the key to measuring spread going forward is twofold. Hotspots peak, like the New York example I just showed you, but also that there aren't any new hotspots. And I think that's very important to show people as well. So when we look at hotspots using data from something called covidtracking.com, which gives you daily tests, daily positive tests, and daily death and hospitalization rates, it's a great resource state by state. And we download this data every night into a spreadsheet. USA is clearly a hotspot. They've gone from 60,000 tests to 150,000 tests a day in the last 2 weeks. And the positive test rate's gone from 15 to 19%. That meets the definition. Within that, New York is the main hotspot in the US. They're seeing tests per day going from 12,000 a day to over 20,000 a day in the last 2 weeks. And their positive test ratio has gone from 29% of those tests to 40% of those tests. Wisconsin, a state that's near and dear to our heart, is close. It's one of those states to watch to see if there's spread. The tests per day here have been pretty stable at around 1,500 a day, but the positive test ratio has creeped up from 6 to 8%. Very important to watch. Putting state-by-state data together across the 25 states that have done more than 20,000 tests so far, there's 9 states that are hotspots, and we're going to watch for a peak there, as the New York example I just showed you. There's 7 states that are close. We're going to watch carefully for acceleration there so they don't turn into a hotspot. And as I find myself entering this data into the spreadsheet, I'm actually rooting for some of these states like Florida and Louisiana to not accelerate again and start looking like a hotspot. And then there's a few states, 6 states, that aren't seeing anything yet, and they may never see it, but we need to monitor them anyways. And there's 3 states that are possibly past a prior peak. If you look at this on a map, you can see the red states are the hotspots. The pink states are the ones to watch, and a lot of them are adjacent to the hotspots: Wisconsin, Indiana, Ohio, Virginia. And the green states are the ones that seem pretty calm right now. The yellow states are the ones that possibly have passed a peak. You can see the red states are concentrated in the north. Some of the pink states are, and the pink states that I'm watching really closely are Arizona, Georgia, and Florida. Because if they start turning into hotspots with the social distancing and travel restrictions we have in place, that points to a virus that's not seasonal and something that's going to last through the summer. So that's a very, very important thing to keep in mind. So question 1, what's the roadmap for reopening once things do slow down in terms of the COVID spread? This piece by the American Enterprise Institute and authored by Scott Gottlieb and his team is an excellent piece for all of you to look at if you want to get a rational view as to what's going to happen going forward. Phase 1 of this is what we're going through now: social distancing, rescale the healthcare system in all aspects to handle the spike, increase diagnostic capacity and testing capacity, et cetera. The big point here is we need to begin to implement a COVID-19 surveillance system. And this is something we haven't talked about and we will talk about in phase 2 and 3. So phase 2 and 3, number one, it'll be done on a state-by-state or region-by-region basis. We're going to need to see a sustained reduction in cases for at least 14 days. And you'll be able to monitor that and people will be talking about it. Once New York starts to roll over, if it continues to roll over, we'll start counting the days, as they did in China, as they did in Italy, as they're doing in Italy. We need, though, an ability to conduct active monitoring of confirmed cases and their contacts. That's something that we're not talking about now, and it's something that has to be in place if you don't want this spread to come back and have a double peak. After the above steps are in place, we can begin to relax social distancing. This will take some time, and we need that active monitoring in place. The other important thing is to identify those who are immune through antibody testing, those that have already had the virus. And that brings us to question 2. Will COVID-19 come back in the fall? It's highly likely it will. And unfortunately, that's something we all need to think about. And Ricky's going to talk about this and its investment implications in the fall. It's a very dynamic situation, but I think you can count on it coming back. Herd immunity will not be high enough given the highly infectious nature of this virus. That's one thing we've learned over the last 3 to 4 weeks. It's not like the flu. It's more infectious than the flu, which you need more people to be and to have antibodies for it to really, really not come back in the fall. This testing is going to occur, but most of the thought leaders believe on a nationwide basis will only be less than 20% antibody positive. And the thought is we need to be 50% antibody positive for herd immunity to take hold. And in certain regions, like New York City, potentially, it'll be much higher than that. We're going to have that data through surveys of antibody testing, probably in the June-July period. It's going to be very important data to watch for all of us to watch. Question 3. What happens if it does come back? Or I'll say when it does come back. Ricky's going to talk a lot about this, but if they're identified, there's going to be the surveillance, testing, and contact tracing that they're doing in China right now and in South Korea. And the question is, will this work? And Ricky's going to get into this in a second. And the question really is, what will be our policy response? And will we ultimately go toward a regional shutdown again? And Ricky has a lot to add to this. And the last thing I'll say about what about vaccines and therapeutics? Therapeutics in the next 2 to 3 months, it's really important that we watch closely for these placebo-controlled results. There's 20 or 30 or more drugs that are in the clinic trying to either reduce the viral load or reduce the body's response to the virus in order to mitigate the morbidity of COVID-19. So it's really, really important to see how these data come out. And Ricky and I, and Ricky will talk about this, we're really, really hoping that a very effective therapeutic will take the intensity around the return of the virus down a notch or 2 or more. Vaccines, on the other hand, there's very, very low probability that there'll be a vaccine ready for the next flu season. We're probably at least a year away from now to have that because we're worried about safety and even efficacy, and we can talk about that in the Q&A. So conclusions, very quickly, the pandemic is regional and will end at different times in different places. We need to monitor to watch for seasonality. We're praying for seasonality, I'll say. And we need to monitor both the peak in a given state or region and the spread from state to state. That's important to watch over the next really 4 to 5 weeks. The return to normal will be careful and slow, as per the Gottlieb report. And the return of COVID-19 next flu season should be a base case assumption. And I'll let Ricky talk about what that means for the future in the investment environment. So thanks for having me here, and I'll turn it back over to Mike.
Thank you, Phill, for that deep dive on the virus and the policy response. I'm sure that'll generate some great audience questions. Next up, we have Ricky Sandler, who's the founder, chief investment officer, and CEO of Eminence Capital, Ricky also comes back to UW as an adjunct professor of finance, which we're very grateful for. Hopefully some of his students are tuning in tonight. And Ricky's going to share his thoughts about the broader financial recovery in light of all this. Ricky?
Great. Thanks, Mike. And Phill, great overview and perfect jumping off point for me to talk a little bit about the financial markets and economic impacts here and sort of the path forward. And I hope everybody is healthy and everyone's family as well. This has certainly been a pretty extreme past 5 or 6 weeks. So in analyzing this from a financial standpoint, there's some things to think about. I think first and most important, it's important to recognize that this is an event-driven shock to the financial markets. This isn't a systemic issue like the buildup we had in the great financial crisis of overvalued housing and leverage in the system. This was really an event-driven shock. And actually, what made this worse was this was 2 event-driven shocks that hit the financial markets at the same time, because at the same time, the Russian and Saudi standoff in the oil markets caused oil to crater from about $45 a share to as low as $20 per share. And while lower oil is generally maybe a slight net positive for the economy, it used to be a much bigger positive, but now we have our own shale production industry. It's actually a pretty big negative for the credit markets. It's only about 2 or 3% of U.S. equities, but it's between 10 and 20% of credit market indices as it relates to a lot of the shale production we have. And so that made this cause some cracks in the credit markets and in other related fixed income markets and fixed income portfolios, which had the feel for this crisis of being a little bit like the great financial crisis, which also had very serious credit market pressure. And I think lastly, there was a little bit of the Y2K. If anybody is, I'm sure a lot of you are old enough to know, but we're investing in the year 2000. That was the sort of digital version. So we had all these aspects of this event-driven shock. And I think in thinking about what is unique here, is number one, the depth of the economic damage is unprecedented, and we've never had the entire economy shut, which it will be for the back half of March and on at least all of April. So that's unprecedented and adds a lot of uncertainty. But on the other side, we have had unprecedented monetary support. The amount of capital that the Fed is putting into the system is unprecedented. And actually, they changed their charter to be able to buy other securities like credit market securities, not just government bonds, which is obviously unprecedented. They've never done that before. They haven't done it yet, but it's a tool they can use. And then our fiscal authorities, the speed and size of their actions have also been unprecedented. They've already approved $2 trillion of stimulus, which is a huge number in just a couple of weeks. Throughout the entire great financial crisis, we only had $700 billion of stimulus. And we've had $2 trillion already, and they're talking about more. So that's been very, very important towards containing this, and I think from a financial standpoint, and I think is unique to this crisis. And then lastly, what was also unique to this crisis was the personal fear and sort of emotion that every American went through, every American, every investor went through in this apocalyptic moment where we all got sent home to shelter in place, to have enough food and supplies, maybe for a month or longer. And that was sort of a weird moment. And then we all got home and we saw the financial markets kind of crashing. And then the story began to get personal. We all began to hear cases from people we know that were a lot worse than we read about. And I think were, by definition, the most severe cases out there. What we don't know, and I'll talk about, and Phill talked a little bit about it with antibody tests, are all of the people who have been asymptomatic and had the virus. So everyone's fear of this virus became extreme. It became a lot worse than I think what it really is. But so in shifting gears to analyzing the markets, I think there's sort of 2 things we need to ask ourselves. Like, how long is this going to go on? How long is the economy going to be shut? How long is business going to be down? Are we going to risk collateral damage to layoffs and then bankruptcies and sort of the wave that happens? And I think there's 2 constituencies we need to understand for this. We need to understand the government, where and what they're going to do, because they impact whether the economy opens. And I wish I felt a lot better about our federal leadership, but I don't. but some of our state and local leaders have done a great job, and the government's going to have to get more coordinated. Their response to date, I think, is unprepared and has frankly been better since. But that's something that is sort of an open question. I do think the government is going to ultimately end up following a path that suggests that what is really bad for the economy is actually worse for human lives than the deaths from COVID. And so I think this will cause them to, with caution, continue to push things to reopen. And then really citizens. And when do citizens go back to life, even if the government said so? A lot of people believe that citizens won't, and there's a lot of factors here. So I'm going to pull up some slides and just talk about what I think the world is going to look like over the next 1 to 3 months, which is very different than what it looks like today. I think today people feel like there's no way I'm going to a restaurant until there's a vaccine, or at least some people. And so what's going to be different over the next 1 to 3 months? First of all, we are going to have widespread availability of both antibody testing and COVID-19 testing, which is important because anybody that has the antibody can feel safe going back to their lives. And even more important, when we start to test hotspots like New York and we randomly sample a group that could be 100 people, we may find out that 40 of them had the virus. And actually only 4 thought they had the virus. And that's going to actually change the denominator a lot. And it's going to make people realize that these unacceptably bad cases were a very small percentage of the young and healthy population. So I think that's going to be important. And then in places that have COVID testing, people even without immunity or older or patients that have a pre-existing condition can feel safe going somewhere if they do an on-site COVID test that could take 5 to 10 minutes, which is Abbott Labs announced that to be available. And then the second thing that I think is important that's going to be available over the next 1 to 3 months is the data and actually the availability of treatment options. Phill talked a little bit about this, which will just lessen the severity of this. You've heard about this malaria drug, chloroquine, that plus a Z-Pak. I have been told by doctors who are working with patients that does reduce case severity by 50% or more. And that's important for people to feel comfortable that as they get back to life, if by chance they get it, and if by chance they're not asymptomatic, and if by chance they have a bad case, at least they can have a drug that will allow them to not have to go to the hospital or not have to go to the ICU, and obviously worst case not face something really fatal here. So I think that's going to be important, and it's going to be available. Next slide. The other things that are going to be important, as Phill talked about, the peaking of cases, we are going to see a material reduction in total cases, and maybe even a near elimination of new cases as a result of the actions that are put in place, plus the warmer weather. I think all the data, Phill talked about the seasonality, and I agree. I'd like to think that all the data we've seen, the fact that the Southern Hemisphere has much fewer cases, suggests that it certainly reacts less contagious in humidity and warmer weathers. Number 4, in the next 1 to 3 months, I think young and healthy people who frankly were never worried about COVID, and everybody saw the young people that were partying on spring break when we got all sent home, they are going to go back to their daily lives and not really worry about it. And those that maybe weren't really worried about it but became worried because of some of these severe cases are going to try to go back to their lives, but with some cautions. Maybe you go to a gym class and you wear a mask. Maybe you're willing to go to a restaurant, but you're not willing to you're not willing to go to a large gathering. But I think people are going to slowly begin to see the data and get a little less fearful of this. And then lastly, and I think importantly, there are going to be an awful lot of people who've been stuck at home for 6 weeks and are just tired of staying home. So I think that you're going to see people, a little bit of pent-up demand, like go away in May is going to be one of my sayings. So next slide. So that's the next 1 to 3 months, and I think it's a generally positive viewpoint where the economy is slowly beginning to open between May and June, and by July, with the summer here, I think we're going to be in pretty meaningful snapback. I'm not saying 100% back, but I think people will be surprised that we could be 80 to 85% back by July. So but that's not the end. And I think that might dictate your near-term investment framework, and it does dictate mine. But the fall is important, and I think there are a couple of things to note about the fall. I think one, I think overly worrying about the fall, I think may be a little too draconian, because I think there are going to be things that can deal with it. But I think knowing it's there is also important. So what's going to be true in the fall? So if the government does a half decent job, and my expectation is that they will, we should have widespread availability of ventilators, testing, and a healthcare first responder network that dramatically alters how we deal with the local outbreak. I think U.S. citizens are going to be on guard and prepared. If I get a fever, if I have a cold, I'm staying home, I'm getting tested. So the best defense from a virus is awareness, broad-based awareness. One of the things about crises is after this crisis happens, the thing we make sure of is this crisis is not going to get us again. So just like after 9/11, we thought the terrorists would come back, and we did a pretty good job at controlling that. Unfortunately, we had some skinheads that decided to shoot up some schools, but nonetheless, we do deal with the previous crisis. And so I think U.S. citizens being on guard is an important part of everybody playing their role. Next slide. And so I think the government's going to be developing a plan for the country to be managing this on a county by county basis, because that's really where hospitals are. And there will be a playbook if we start to get a local outbreak of distancing, of work from home, and maybe cordoning off a county, and making sure we can manage it and stop it. And I think there's going to be continued comfort, though, that if I do by chance get it, it's not the end of the world. And so my conclusion here is don't bet against the resiliency of the U.S. consumer. They have short memories and they're going to come back. And also don't bet against our healthcare system. And so I think they will come up with treatment options to help. And so that just leads me to my final sort of market view, which is I think markets continue to recover. The overall market may only recover a moderate more from here. We've come a long way, and we're surprisingly not that far from where we were at the start of the year. So I think the market could be maybe 5 to 10% higher. And then I would say you want to, they'll bet on the sectors that have been hardest hit. So the consumer discretionary sectors, the leisure sectors, I think are important. I think tech has held up really well. And I think you're going to start to see market leadership change here, where value and consumer discretionary start to take a hold. And then mid to long term, we're going to have to talk about the degree of recovery that really will happen on the other side of this. Do companies run with less leverage? Do consumers save more? Did this have any long-lasting impacts which could impact sort of the shape of the recovery or the strength of the economy beyond that? And so now I will pass it back to Mike, who might then pass it to Julie to give us a longer-term perspective.
Thank you, Ricky. Appreciate your investment overlay on the situation. Apparently, the quarantine lifestyle isn't as great in the Hamptons as I was imagining. Julie Van Cleave is the Chief Investment Officer of the UW Foundation and previously ran mutual fund strategies in separate accounts for Oppenheimer Funds, Deutsche Asset Management, and Mason Street Advisors. She's going to share her views on the economy and the markets and the UWF endowment. Julie, thank you.
Great. Thank you, Mike. I'll start off with the UW Foundation, which is ranked 32nd of 800 higher education endowments in North America. And we are designed to be a perpetuity. That is, we seek to maximize total return and deliver campus support without having to rely upon investments that have a strong income focus. That is, we can own stocks, bonds, private equity, and real estate with the goal to have strong total returns over the long term. So it's really a great seat to be in terms of being as an investor. But let's take a look now at the situation we're in. We came into the year, into 2020, with a strong economy, good corporate earnings, and low interest rates. The economy was strong with just a few visible clouds. So now we're looking at what we've just been talking about, the health crisis, a financial crisis, and an economic crisis. I can take these apart a little bit and give you some thoughts in terms of how we're looking at those. So the health crisis has been well discussed already tonight, and I think you've got some great insights from both Phill and Ricky. And I'd have to say, as an investor, it's a lifetime for most people to see a health crisis of this scale and then know what to do with it in their portfolios. It's new, and we can argue about the policy response we've had so far, but I think at the end of the day, it'll come down that 2020 is the year of the virus. So talking about what it's done in terms of really igniting a financial crisis, since we have been accumulating a lot more debt in our system since with the low interest rate environment since 2008, we've kind of set the stage for a financial high impact financial crisis, which we've been enduring particularly in March. So one manager I recently talked with described that the second half of March here had the same market stress as the entire great financial crisis of 2008. And that's really because we've had these major dislocations in the financial market. Basically, the bond markets really had some tight liquidity issues. However, the difference this time from where we were in 2008 is that in 2008, the Fed and the Treasury had to come up with a whole new set of tools to deal with the issue. This time, they were able to literally pull them out of the pocket and have responses put in place in days and not weeks and months. And people kind of forget how long that whole policy response took in 2008. We've had a very sharp response so far. So we've stabilized commercial paper, the municipal bond market, short-term debt trading, and we're on our way to having a much more stable system. The CARES Act and other fiscal measures have, and Ricky mentioned this, but effectively added the equivalent of anywhere from 4 to 10% of GDP, which is tremendous. So all this done with remarkable speed, magnitude is enormous, and surprisingly bipartisan. So talking a little bit about the economic crisis, and I agree with both Phill and Ricky, sudden severe storm is what we've been enduring. And I like Mike's hand signals. Is it a V? Is it a W? Is it a U? We're not investing as if it's a V. We think that there will be some longer term effects that we're going to see in the marketplace. So just looking at what kinds of things that we'll expect to see on the other side of this, just like there were impacts after the great financial crisis, we expect to see some things as larger trends in the economy. And one is higher consumer savings. We think consumers will focus on rebuilding the savings that they're losing this year out of necessity, and also try to build a cushion. So that could mean lower big ticket sales for things like autos, more price sensitivity on housing, both in home sales and apartment rents. We're also thinking that low interest rates will continue for the foreseeable future, as the Fed and central banks will keep ongoing support through lower interest rates. And we're going to continue to have great government presence in our markets. Employment will rebound, but it's still in the state right now of declining, as we can't, the systems aren't able to capture all the unemployment real time in the system. So, but it's expected that we're going to eclipse the 1982 unemployment level of 10.8%. Some people are thinking it's going to settle out in the mid-teens. So we will have, in a very short order here, a pretty bleak-looking employment picture. Low inflation, but we do expect it'll bounce. Some of it, given how quickly it went down, that there will be some of that brought back relatively quickly. We do see low inflation as continuing, and that is, as Ricky mentioned, what's going on with the energy markets. Ultra low commodity prices, including oil, can be a damper on inflation for a while here. However, in 2021, we could have some pent-up demand hitting lower supply. So think about people booking airline flights next year, as people are glad to get out and go someplace, but maybe all those airline seats won't be there. So there'll be more demand than supply for some things that people are looking to consume. And then we think there'll be ongoing changes to the supply chain. So localization is growing. We've seen the strains of having long supply chains that are global. So it's also possible we're going to continue to have trade frictions and we might not have seen the worst of it as countries seek to defend their own interests. So we expect that trend to continue. So in looking at all those kinds of things and what the landscape could look like, in our managing the endowment fund, our endowment model might be similar to some of you who are thinking about your retirement plans or other longer term investment programs where you have a goal in mind of what you want to accomplish, and you strategically allocate between bonds, stocks, and cash. But now we have to include COVID-19 as we really have to think about the politics, finance, and economic conditions around that. We have to learn how we're going to live with the virus and how we're going to invest with the virus. So our strategy is pretty straightforward. Number one, we're going to take advantage of our longer term horizon and focus what we want to own in 1, 3, and 5 years. So when you have an immediate market dislocation like this, you really want to think out what do you want to own in 1 year, 3 years, 5 years, and then you can start doing something with your allocations. So right now we are keeping our discipline, staying close to our strategic allocations. We really like the portfolio we have right now. And coming into the crisis, we were well positioned with a very high quality investment portfolio position and ample liquidity. So we haven't had to sell anything. We're positioned with over 60% of our endowment assets available in 5 days or less, which is just tremendous. So we also have a very strong exposure in the portfolio to the healthcare sector. And we think that this is going to continue to benefit our portfolio as society continues to put more resources towards public health. Secondly, we're going to focus on, and I'm calling this quality today and cyclicality tomorrow. So that means we will have a rebound, but we think that there could be more things in the short term that can continue to disrupt the market. So including what Phil was talking about, a resurgence of the virus, say if we get a break in the summer and could come back. But we also see that there's, so it will depend on public health policies as we relax the lockdown. But we do see there's a potential for sharp increases in bankruptcies. We just haven't had the time to see those yet in the market. And credit downgrades. So one estimate I heard recently, like today, that there's pending 900 billion of bonds subject to downgrade from investment grade to non-investment grade this year. That would be just a lot of headlines that the market's not going to like, and some losses. We do think that we'll have time to evaluate those things, and especially want to keep an eye on the fixed income market. I think the equity market could act and behave very differently than what we're going to see in fixed income. Given that we're an endowment fund, we can look to lean into risk as we find opportunities, but in general, we think we can earn very good returns over time when our endowment is ultimately invested in high quality companies with strong financial strength and good balance sheets. So I've got just a couple slides, and let's look at the first slide here. This is just to give you a sense of what can happen in the markets over time and what we've seen. So the green bars are the annual returns when they've been positive, going back to, I think we're in 1995 here. But you can see most of the time we do have nice green or positive returns to the equity market. And we have had some years, for instance, 2008 was minus 38%, and we've had more recently in 2018 it was down 6%. You see those little numbers underneath there, though, those are the inter-year declines. So if you look at, although most of the time we end up with a positive return, on average over this time period, the average market drops about 14% within the year at some point. So that's the low point for that particular year. So as equity investors, you get very you have to get used to these downturns. We don't know how this year is going to end up, but we already have a very strong decline that is coming back, as Ricky mentioned. So anyway, that's part and parcel of our market, and but I think it's helpful to look at that. And then with the next slide, this rolls this up into some longer time periods. So here we're looking at the period from, I think I've got 1950 to 2019 here. And this is for the for a single period, a 5-year rolling period, 10-year or 20-year periods. The green bars are stocks, the blue are bonds, and the gray represents a 50-50 portfolio of stock and bonds. So you can see in the little table on top that through this whole period, the average annual return for stocks is 11% and bonds is 5.9, and the 50-50 is 8.9. So overall, it's been good to be in the market in this time period. When we look at individual 1-year periods, you can see it, the worst is minus 39%, but the best year within that time frame was up 47%. And you can see the blue bar there for bonds, minus 9 up to 43, et cetera. But as you go out further into the 10 and 20-year rolling periods, you can see on a blended portfolio, and that's what we're managing here, which would be we have a little higher equity weighting than the 50-50, of course, but the gray bars is that they are above the positive line there on the order of 16% for a 10-year rolling average on average. So there are returns to be had out there, and we think that this is going to be one more of those downturns that will be followed by better periods ahead. So the third thing that I think to think about, and it's just one more concept, is to follow the Fed. So right now, and Ricky mentioned this, the Fed's in there very unusually buying corporate bonds, investment grade and above. And so this is something where you can have confidence as an investor to buy what the Fed's buying. And they will provide on the margin support to that part of the market. So keeping in touch with Fed activity and watching what we're doing is very important. So to summarize for us, we think that we don't know the exact path that this is going to take. It could be U, V, W, L, pick your letter. But we do think that we're seeing some good mitigation efforts in the market, and we're well positioned coming to the crisis. So just finish up real quick with one last slide here. And Warren Buffett, I think, has had some good thoughts over the years. And number one is our favorite holding time is forever. So if you're positioned and you don't have to sell, you can do just fine through these periods. And we also want to focus on high quality, be proud of what's in our portfolio. And it takes 20 years to build a reputation and 5 minutes to ruin it. So we're always looking at doing the right thing with our investments.
Thanks, Julie. I think we've got a lot of audience questions coming in, and I'm going to throw one right back to you, Julie, to get started here. And that is, you talked about following the Fed. Obviously, the Fed did some really innovative things, as you noted, in the great financial crisis, and they have even expanded the toolkit in the current crisis. How far can the Fed go, and do you think the Fed will ever start buying stocks? It's happened in other countries.
Right. We have seen foreign central banks make purchases of, and they've been doing this for years, say in Japan, both equities, stocks, and corporate bonds. The Fed does have a very broad mandate and can significantly expand its balance sheet, which it's already starting to do. So we do think that the Fed's got a big runway. There's, in terms of the total global environment, the U.S. central bank balance sheets actually as a proportion of GDP is much smaller than what we're seeing in Europe and Japan. So we think there's a lot more to go there.
Great. Phill, question for you from William. What do you think is going on in Ohio? What have they done to keep their caseload relatively low?
In any of these situations, these states that are that have low caseloads, there's a couple things going on. One is possibly could be just a function of testing, and we'll need to wait 3 or 4 or 5 weeks and see what happens to the hospitalization rate, and to understand whether it's just a function of low testing. It's actually hard to understand why a given state like Ohio hasn't had social distancing rules that were any different than any place else, have not been, had a extreme increase in the number of cases. I think it's more like Ohio is in a normal situation, whereas New York, with everybody very, very close together, Detroit with everybody very, very close together, Atlanta is more causing an acceleration of the spread of the virus rather than what one state's doing to avoid it per se.
Great. A question for Ricky from audience member Mike. You had a number of assumptions layered in there for getting back to normal, some of them having to do with medical assumptions. And can you say, what is really most important in your mind? Is it widespread availability of testing? Is it the development of treatments that mitigate the effect of the coronavirus on individuals? Or is it a vaccine before we can get back to normal?
Well, I mean, I guess ultimately it's all, and that's why we probably are not getting all the way back to normal. I think there may still be some people who may be afraid to engage back in their lives without a full vaccine. But I think all these other things will make a large percentage of the population comfortable. They will make people understand that if you are under 75 and don't have a pre-existing condition, perhaps the hospitalization rate of that age group is only low single digits, and that's before we have any treatments like a Z-Pak or chloroquine. So obviously there's still unknowns, but my point is I think all these things will slowly give us an understanding. Everything that people knew about this disease before was that while it was highly infectious, it wasn't highly deadly, at least to an 80% of the population that is younger and healthy. So that still needs to be proved out by the data.
Phill, do you want to chime in on this issue? What's most important for us?
Yeah, I mean, I think it's really, really important to understand that a lot of the anecdotal evidence that's out there about the antimalarials and about the antivirals is just that. It's anecdotal, and I just am not sure what's going to work or not. And I think we need placebo-controlled trials, and we need significant benefit in the patients that are treated with those. And this comes from talking. I'm not an MD, but we've done literally 20, 30 calls with physicians who have looked at these, looked at the data from France, looked at the data from Italy on some of these, looked at remdesivir, which is the Gilead drug, to see whether it's going to work. It's very, very uncertain right now what's going to work. I think we'll have clarity around August or September before the virus returns, because these trials, as Anthony Fauci would say, you need to do placebo-controlled trials and find out if they are going to work. On the vaccine front, this is an RNA virus, and viral vaccines aren't necessarily, they're not that common. The new genetic work that's done means you can identify the parts of the virus that you can go after and create immunity on. The world, it's very, very uncertain whether these viruses will induce the immune response we want, even a year from now. And the reason they can't come out for a year from now, they're all a different format. They're not the live attenuated vaccines that we're used to seeing for flu. Those work, and it was pretty easy with the H1N1 to just plug that into an existing system. Now you have a completely different system that you're trying to induce immunity with, and that may very, very well cause side effects. So if you treat millions and millions of patients and 10 or 20 or 30,000 have a severe Guillain-Barré kind of response to it, you're really, really causing more damage than good. So I think in the vaccine area, this is a new area. Viral vaccines are an untested area, and you're going to need to do 10,000, 20,000 patients in a clinical trial before you're sure they're safe.
Great. Question from Jim in the audience. A large percentage of U.S. workers have no savings, no health care, and no sick leave. How does that play into recovery scenarios, Ricky?
So I would say, first of all, people that have some of these things didn't have some of these before. So I'm not sure it changes what the economy looks like on the other side. We had a record low unemployment rate before this in the mid threes. So I also think that the support from the government is unprecedented. Money is in people's hands very quickly this time. Companies are all applying for these loans to be able to pay their employees. Employees that are furloughed are quickly getting on government payrolls, and there are legitimately people at the lower end of the spectrum that are getting paid more to stay home than they did to work. So I think for a period of time, this is well cushioned by the government. government. Obviously, in every one of these ecosystems, whether it's restaurants or hotels, you will see the weakest close. I mean, this will force people to make decisions, and they will then lay off their workers, whether or not they're allowed to reopen, because crises like to wash away the weak. I believe in that slowly the economy will rebuild, and somebody will reopen that restaurant. Some entrepreneur will reopen a restaurant, and I don't think we're going to eat less, to go out for dinner less. And so, but there will definitely be some carnage in each of the subsectors in terms of companies that use this crisis as the final nail in the coffin.
Yeah, and I might add something. One thing that I think that we're seeing in the asset-backed security market, which is really auto loans and a lot of the consumer debt out there, is that there is a lot of talk about forbearance, or effectively consumers not being, obviously not what they're not paying, but some loan forgiveness or delays in payment, those kinds of things. So, and some consumers will either not be able to pay or not pay, thinking that no one's going to come after me in this type of a crisis. So we can see a lot of things, and we're watching with what's going on with consumer debt and how that's getting paid. So it's good to see in the crisis we've got some rent relief and some of those things. There's also an impact on the asset owner side too, as these programs go through. So there's a lot that will be happening on the consumer balance sheet for those that have debt.
Ricky?
Yeah, and I think, Julie, that's a really good point on the forbearance. I think I neglected to say this in my comment about the government, but I think it's true of industry as well. The government has been very, very clear that this is nobody's fault. They're not looking to blame anybody. They're not looking to take their pound of flesh like they did. And I think industry is coming to aid their own partners and their own colleagues and their own counterparties. So I think that kind of support with forbearance things, and if everybody just kicks the can down the road by 60 days and the government fills the bucket with money, we may just actually be able to bridge to the other side.
Yeah.
Phill, Dean Samba wonders, what can we learn from China or Korea about testing, contact tracing, or vaccines? Sometimes we talk about it like we've got to do all this ourselves, but of course, everybody's working on this problem. Will we learn things from others?
We definitely will, in terms of contact tracing and the entire infrastructure on COVID-19. What they've done in South Korea is literally have a passive iPhone message system that a lot of you have heard about, that will send you a message if you've been next to somebody who's tested positive for COVID-19 and ask you to get tested. I'm not sure in the US we're ready to do that. In China and in South Korea, I think there is a little bit more severe restriction level when it comes to travel and monitoring patients, or monitoring positive patients and their contacts. And I think one of the things happened in China that's interesting is originally, at the very, very beginning in Wuhan, they sent the positive patients back home to quarantine with their families. One of the first things they learned is that when you do that, the second infection is worse than the first infection. That led to a expansion in the deaths that happened. Same thing happened in Italy. One of the things China's learned, when you saw them building that hospital in China and in Wuhan, what they were really doing was making somebody who is positive isolated from even their relatives. And that's what we're seeing a little bit here. We're late with it, but what you really need to do is build a hospital and put those infected individuals together and not have them be a part of their own family. Because then, regardless of the precautions, there's a high likelihood you're going to infect them. And that's what started the Wuhan, epidemic originally. And they learned that really quickly. And that's a mistake they made initially in Lombardy in Italy.
First, Julie, and then Ricky, I'm wondering if you could address how the magnitude of federal deficits that we're now racking up and the extent of quantitative easing will ultimately affect long-term U.S. economic performance, because it seems like we've just thrown all that out the window for now. We're not going to worry about it. We're going to have to add some new space on that debt clock that I see when I go to LaGuardia from Manhattan. What's going to happen here?
Yeah, we're back at debt levels to GDP we haven't seen since post-World War II. So in terms of when do we have to pay for this, one thing that is a mitigating factor for the U.S. is that it's happening globally. So we have pretty even currency and trade flows around this dynamic. But in terms of taxes, yes, I think it's when people really start looking at what we're doing, there should be some tax impact. And the quantitative easing, I think, and this is where we're issuing debt and the central banks are just buying it. So it's a self-consumption of our own debt effectively. When you look at where sovereign debt or government debt is held around the world, it's really held by central banks and other large institutions that are forced to own, especially some things like negative yielding bonds. So ultimately, there'll be a price to pay. I think it's going to take a while before we get to that point. We've been arguing about QE and the cost of it for 10 years, and that could continue for a while.
Ricky, thoughts on that?
Yeah, I mean, I think Julie summed it up pretty well, which is that we've had this unprecedented increase in government debt around the world, and frankly, we have the lowest interest rates of government debt that we've ever seen because central banks are buying it and printing money. If you print money, but the money doesn't multiply, you may not actually increase inflation, which is sort of what's happened in the economy so far. Over this period of time, I think longer term, one has to ultimately be concerned about a different kind of crisis of government fiat currencies and whether something like gold is a good investment. For the first time in my fund's life, we bought gold about 3 weeks ago because I do think that ultimately on the other side of this, there kind of has to be some inflation when the governments just spend whatever they can to get through this.
Phill, can I ask you, somebody wonders, why are we not treating patients with gamma globin as we did that work for Ebola and other diseases? Why wouldn't we do that using those substances from recovered patients?
Yeah, and again, from talking to experts in this area, that's probably the most exciting opportunity that we have in terms of treating these patients. It's called convalescent plasma. They're starting clinical trials right now, just like they are with all 20, 30 of the drugs that we've talked about or that are in clinical trials. They're going to be placebo-controlled trials. They just issued an IND, I think, last Friday, or no, actually, it was on Monday. Yesterday, in order to start those trials with placebo-controlled trials. The thing about convalescent plasma that's really, really important, and Alan Zabalski pointed this out to me from one of our calls that we had, it's going to give us a really good indication as to whether or not a vaccine is going to work. Because convalescent plasma is a gemisch of antibodies from a patient who survived a number of antibodies, not just one. Not a monoclonal, but polyclonal and a number of antibodies. And what the thought leaders say is if that works, it gives you a better shot that an antibody induced by a vaccine is going to work. If it doesn't work, you've had a multiple of antibodies that are treating a patient. And if it doesn't improve the patient's status, it makes it a little harder to believe that a vaccine is going to induce an antibody response that will be preventative. Just a little sidelight. But convalescent plasma will be in clinical trials. We're going to see results again, probably through the summer, to see whether that actually works.
I'm going to go back to Ricky and Julie with a question. One of our viewers wonders, how is this fiscal stimulus actually going to help, especially that's targeted at households when people can't go out and spend money?
Well, so I think that's kind of the beauty of the pent-up demand that we have. Surprisingly, when we get to the other side, some people are looking at the crisis and being like, no one's going to have any money to go on a cruise, to go out to a restaurant, to do X, Y, and Z. And actually, I think people will, because their spending will be down and their income will be flat to up. There could be some negative wealth effects, but it'll depend on where the market ends up. But I definitely think that's one of the points that makes me a little more optimistic about the pace of the recovery.
Yeah, I agree. But I do think we have to be very sensitive to what that income level is for that consumer. So this is a very significant recession for the big percentage of our population who have lost their jobs or are in the throes of it right now. So that's an issue, but I do think there will be some pent up demand, as I mentioned, for next year, or maybe it's going into the fall, but I do think people will be more cautious, and I do that savings trend I think is going to be there. So I think a lot of people will be looking to replenish their savings.
We got a final question here. It's really sort of a money question from someone named Richard. Julie, I wonder if it's Richard Shepley, based on what the question is. Richard helps run the endowment. Richard wants to know, where's the S&P going to end in 2020? Where will the oil price end the year? And what do you think GDP growth will be for 2020? And I'm going to start with Ricky, and then Phill, and then Julie.
Sure. So let's work from the top down. GDP, I obviously expect a fairly significant snapback. I think in Q3, I think GDP is one of those sequential things. So maybe I'll just talk about sort of the run rate growth and what it would look like year over year. And I think in the back half of the year, we will see GDP growth rates year over year that are positive, maybe plus. Q3 could be +3. Because of the pent up demand, maybe exiting the year at sort of the 2% kind of moderate growth rate would be my view. S&P, I think, ends the year higher than here, but down for the year. So I would say probably there's another 10% in the market, maybe a little more, maybe somewhere between 2850 and 3050, 3,000, somewhere in that range. I think the S&P ends the year. And then oil, I think, stays low. I think the Saudi Russian thing just exposed how much supply there is in the market, and I think oil ends the year between $20 and $25.
Phill?
Well, the way we run money at Adage, we don't bet on anything having to do with the economy or the S&P or anything. So I'll freely say I have no idea, and I will also say I don't think anybody has any idea, because I think the policy reaction to the return of the virus next fall is really, really hard to predict right now. We know it's coming back. We know there's going to be cases rising in certain locations. We know they're going to try to do social distancing and, well, initially trace and test. And if that doesn't work and the cases continue to rise, I think people are going to really, really get nervous about what's happening out there. So that's just a look at it from looking at the data and expecting the virus to come back.
Phill, you're invested in Adage and cash, huh?
Yeah.
Okay. Julie, what do you think?
Well, I invest in everything. So in terms of the S&P 500, just so people kind of have a sense, we started the year around 3,200 on the S&P, got down to 2,200, and today we're around 2,700. So I think it's going to be hard to get back to where we started the year. So I have more modest expectations, but I think we've seen the lows potentially. But it does depend on what happens with the virus. So there's a big question mark around that, because it's really a giant factor in the markets. And then in terms of oil prices, right now they're at $25. There's no commodity that moves around quite like oil. So we can go from 80 to 20 to 40. All these things can happen. What will be interesting to see is if how long oil prices stay down, what kind of production is shut in, or if they just keep pumping. So there's a lot of duress on the markets and the oil markets down here at these prices. So naturally they should go up when we have a demand increase, because right now we have almost no demand and lots of supply. So it's kind of the bear environment right now, which I think should get better over time, but no time frame. And GDP, I think we're going to go down very hard in the next couple quarters. 2019 was a good year. We had a good fourth quarter GDP. I think that'll be tough to break. So I'd put kind of a very modest, but modestly negative GDP for the year.
Great. Well, look, thank you all for, I want to thank our audience for joining us tonight. We had a great audience tonight, right up to the end, well over 1,000 people at this event. So we are shattering all records for alumni events now that we're using this digital format. I especially want to thank our experts for joining us. You're all great friends and great Badgers, and it was fun to spend some time with you talking about the economy. And I'd also like to encourage everyone to join us same time next week, where we shift our attention back to the public health crisis in the front lines. And we'll have Dr. Alan Kaplan, who's the CEO of UW Health, and Dr. Bob Golden, who is the Dean of our School of Medicine and Public Health. So thank you all for being with us tonight, especially our panelists. Great to see you, and on Wisconsin.
Thanks, everybody. Stay safe, everybody.
Thank you.